Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this session, we have Scott Nations, president of Nations Indexes. We're here to discuss why the speed with which volatility has decreased after the spike from earlier in August is another indication that traders want to sell spikes in volatility. Scott, it's great to see you as always. Welcome back to Trade Talks. And that's one consistent theme that you have been discussing here on Trade Talks is this need for traders to sell vol, and that trade works for as long as it does until it doesn't.
That's right. And we see lots of products and lots of traders that want to be short volatility. And they really want to be short volatility. They really want to sell it after a big spike. And that's understandable. We want to sell when prices are high, and option prices are high when vol spikes. The problem, Jill, as you pointed out, is that this will work until it doesn't. And, in this last spike, we saw volatility revert to very close to its mean very quickly, a matter of just a few days. When in the past, that might take weeks or, before the turn of the century, in the 80s and 90s, that might take months or years. And now it happens in the span of a couple of days. And again, I understand why traders want to do that. Again, they want to sell option prices. They want to sell options when prices are very high. But Jill, this works until it doesn't. And there's going to be some extended period of panic in the equity markets where volatility spikes, gets high, people sell a bunch, and then it spikes even more. And then it's going to be really ugly for some of these vol sellers who rush in.
Yeah, it seemed at this time around too that people were selling vol at relatively low levels as well.
Yeah, implied volatility has been relatively low until the recent spike. Mm-hmm. And that's been fine for sellers because realized volatility has been relatively low, even though the market's done pretty well. It's gone up in a very methodical, very low realized volatility environment. And in that situation, selling options, selling implied volatility has worked out really well. So I think part of what's going on is that traders have learned the wrong lesson in selling implied volatility. They've learned that it always works, and we know it doesn't always work. In fact, the trade has some unfortunate convexity to it. You're defining the amount of money you can make when you sell volatility, and the amount of money you can lose is effectively undefined. And so I think traders are learning the wrong lessons when they're selling implied volatility.
Yeah, that's a good point that you make. And let's talk about some of these names that really garner a lot of trader investor interest. NVIDIA, as an example, of course, earnings coming up on August 28th. And I would imagine that's all the headlines we're going to be seeing over the next week and a half about how NVIDIA performs for the quarter, what guidance looks like. But if you isolate some implied volatility information, traders can get a sense of the expected range of the move around earnings.
That's right. If you look at something, I looked at it earlier, August 30th. Is the NVIDIA option expiration that will fully catch that earnings announcement. And so if you look at that, you can look at option prices and see how far the market would have to move for you to make money on, say, buying the straddle. That is the put and the call in that August 30th expiration, which both have a strike price very close to at the money or at the money. And that will give you an indication what the market thinks the move is likely to be. That is the expected move. The thing about NVIDIA is it has been the poster child for the stock market this year. Very understandable. It's done just beautifully. Congratulations if you've owned it. But as we go into earnings, there is one thing interesting. There are only two names among the 10 biggest in the S&P 500 that have call skew, that is, out-of-the-money calls are more expensive than out-of-the-money puts, and NVIDIA and Tesla are those two.
Let's talk about some new product here that traders are going to have exposure to, options on VIX futures. So let's use this as a learning 101 moment here. Is that similar to S&P options on futures? And if not, or if it is, what is the distinction between the two different ones?
Well, they're similar in that they're both options on futures contracts. I think one difference is that there are traders, largely institutional traders, who really, really use S&P futures. And so for them to have some sort of product that directly expires into a futures contract in the S&P makes a lot of sense. Also, there are issues about the fact that S&P options on the actual index trade on one exchange, Options on the futures trade on another. None of that applies in the case of VIX. They all trade on a single exchange. They're all going to settle to a single number. So I'm not certain that options on VIX futures make a tremendous amount of sense. I'm not really certain there's going to be a big use case, with one exception, Jill. And that is that because it's impractical, very impractical actually, to replicate the VIX index, the futures and the spot index, the futures price and the spot index value will diverge, because let's remember, the VIX futures are a future. And so because those two will diverge, I can see situations where people may want to use options on the futures rather than options on the index. But if you're going to take them to expiration, they're all going to settle to the same number anyway.
All right, Scott, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.